Hi everyone, today I'm going to present the study about the puzzle of capital structure theories and financial assessments review. First, I will talk about the introduction of the study, and the second place I will talk about the objective. In the third point, I will talk about the capital structure theories and financial assessments. In the fourth point, I will talk about the capital structure and the battle of financial assessments. In 5 point, I will talk about convergence of financial assessments, and last point, I will talk about the conclusion. Myers, 1984, associates the problematic of the capital structure with putting together a puzzle with a set of difficulty pieces, and for that reason, Hara know why companies issue stocks, bonds, or a mix of this class of securities. Traditional theories of capital structure are based on a series of assumptions started by Modigliani and Miller and studied trade-off theory. New empirical approach for the financial decision of the firms have introduced modern analytical tools in the analysis of company financial decisions, like agencies cost, transaction costs, and country information economics. The main objective of this paper is to make a synthesis of the studies that have used country-specific factors, special macro-financial factors related to the financial systems to explain the capital structure choice of the companies. The company first use internal funds to finance new investments. Then they use external financing, such as bank debt, bond issues, and the last placed equity issue. Rylin Myers indicates that internal financial funds are dominant source of financing, about 75% of capital requirements. This observation is consistent with the finding of Rajan and Zingals on their international comparisons of capital structure in 7 countries of LCDE. The same results for the study of capital structure of Bertero for the French and banking sector and capital markets. The battle between different financial systems began with the process of financial liberation in 1917 in some countries, particularly in the United Kingdom and France. The financial market program increased competition within and between the banking system and of the European Union member countries and between these systems and the capital markets. Here we have some studies between 1994 and 2008 that studied the capital structure and the battle of financial systems. Martero, 1994, studied the interaction of banking systems, financial market, and capital structure of French companies and observed two important links. One link between change in banking sector and security markets, and another link between the financial pattern of French companies and capital structure. Rangel and Segal's 1995 did not observe significant difference and indicates that behavior of leverage is similar between firms from countries with a capital market-based financial system and firms from the country with a bank-based financial system. Miguel and Pindado 2001 do not indicate a significant difference in corporate debt between the two financial systems, and the financial intermediary helps companies to reduce the adverse selection and moral risks. Tan et al. 2005 tells that in countries with a well-developed banking sector, companies prefer use bank credit, and the countries with a capital market-based financial systems, companies prefer to issue bonds rather than new shares. Antonio et al. 2008. The study suggests similarities and difference in the determinants of leverage, and difference in the the impacts tangibility, capital requirement, profitability, tax rates, and the speed of the adjustment of leverage. Barrow and Sala Martin relates the understanding of financial patterns of firms with the question whether the different financial systems of the European Union have shown a tendency to converge over the time. Here we have some studies between 2001 and 2020 that study the convergence of financial systems and capital structure. Smith et al. 2001 examined the financial system in Germany, France, and the United Kingdom. The results indicate that German financial systems remain banking sector oriented, while British systems remain capital market oriented. Erdmann et al. 2003 compared financial system structure in the Eurozone, the United States, and Japan. They observed that financial systems in the Eurozone member countries continue to be bank-oriented. However, banks play a smaller role in providing financial intermediation. Murin et al. 2004 for the European member countries tell that do not exist a significant evidence for convergence in the use of bank debit. However, exists a significant evidence into the use of internal funds and the issues of equity to finance their new investments. Schmidt and Eckert 2004 for the German, Japanese, and American firms suggest that internal funds as the dominant source of financing the firms, and the difference in financial systems are related with corporate governance. Milewins and Callias 2010 for the German, France, Spain, and Italy suggests the existence of a continuous convergence over the time for the four capital markets, particularly with a higher degree for the coverage in the French and Germany. Bruno et al. 2012 study using deposits, debit securities, shares, and insurance, and the study suggests the convergence of the stock market and the insurance products, and do not show a coverage for debit securities and deposits. Klein et al. 2017 studied the convergence of financial systems and the Eurozone and found convergence in all country members in the banking sector and capital market. Borising Ecolanson 2018 found that before 2008, companies used bank loans, while the post-crisis they increased bond issues that became a preferred alternative source of financing. Christoph et al. 2020 they observe a strong convergence in terms of the use of equity capital against total liabilities and bank loans against total liabilities. The review suggests that the configurations of financial systems influence the financial decisions of companies in different countries, and the next slides help to complement the puzzle on the issues of corporate capital structure. Capital structure is explained by theories like trade-off, agency, pecking order, and market timing. And the capital structure is influenced by financial systems, like the capital markets and financial intermediaries. The financial intermediaries help the companies to reduce transaction costs and information costs, and the capital markets help to the companies to issue new shares. The puzzle of capital structure problem is explained by theories based on market imperfection, just as the existence of transaction costs, asymmetric information, and stock market time. The capital structure is also influenced by the concept of financial systems, where financial intermediaries play a key role in reducing transaction and information costs. The efficiency of capital markets contributes to reduce the information costs and incentives companies to issue new securities, with a special attention to companies that are able to time their new issues of shares. Thank you for your attention.